Hello, hello, hello. Let's see. Hi, everybody. We're back. Let's get it. All right, we got Jerome Powell speaking here very soon. So that's a live stream today. Be trading this news. So let's see what happens here today. The goal is to focus on execution, our focus, and our patience, honestly. All right, I got this up over here. So let's see. All right, I'm going to take this off, move this over, so we can trade and watch this at the same time. Here he is. There he goes. My guy, let's go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power. especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Yeah, buddy.
We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw more evidence of that today in the JOLTS report, as you'll know. It's still
basically like 50-50. Nothing like too bad or too good here.
And the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored.
Are anchored.
Are anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, you know, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So one, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And For sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the
Sweet.
easing in financial conditions since November contributed
All right.
to the acceleration in growth?
Almost bought those damn calls down there, but it didn't.
Tighter financial conditions will be needed to resume the sort of disinflation.
All right, this guy's good,
we
actually.
saw last year.
So
Pretty sure his
I think
name's
it's hard
Nick.
to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at let's look at growth. Really,
Look at this 4-hour gap
what
here.
we've
We're coming
seen
back
so
up
far
above
this
it.
year in the first quarter.
I want to pay attention to this gap
growth
here.
coming in about consistent with where it was.
We get a
last year.
consolidation now and a
GDP came in
retest of
lower.
that gap.
But you
That'd
don't see
be
an
good to go
acceleration in
higher.
growth. I mean, the thought would be that
Back up to these highs up here.
conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation? We'll have a better sense of that over time.
I like
know that
this.
There's an
There's a
obvious
good movement
connection
here.
there, though, with the easing of financial
Pulling
conditions.
back down.
In terms of tightening, you're right. I mean,
After a
rates
lot
are
of
certainly
bullishness.
higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions. And
We got a
that's
5-minute
appropriate
inversion for
given
value gap
what
right here.
inflation has done in the first
So
quarter.
we pay attention to this 5-minute
You've said in
inversion.
the past that stronger growth wouldn't necessarily
We
preclude
got highs up
rate
higher.
cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't.
I wish those calls got filled. That'd be crazy.
Inflation. It is one of the inputs. With wages is, of course, we like everyone else like to see high wages, but
That'd be a big
we
bag.
also want to see them not eaten up by high inflation, and that's really what we're trying to do.
Yeah, so we got a lower low now, higher low.
and
in that
work
area.
with what's happening on the supply side to bring the economy back to 2% inflation.
You got a
Part of
30-second
that
inversion
will
right
probably
there.
be
But now we're just pulling back into this
wage
range
increases
now.
Move down incrementally.
I was
toward
gonna be
levels that
patient
are
with
more
this
sustainable.
move. It's likely to keep moving up. I wouldn't want to see this low. Well, down below here, broken
Hi,
now.
Cheryl. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%.
Here we go.
It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said.
Good question.
And I today said that
Put him in the spot.
we didn't see progress in the first quarter, and I've said that it appears then.
I want to see more consolidation in here. Maybe to take this low one more time.
I don't know how long.
And
it'll
then
take.
maybe we get a push back
I
up.
just say,
But as of right now, I'm watching
when we
this
get that
30-second
confidence,
inversion.
then rate cuts
We
will
came
be-
back up
will be
above.
in scope.
And now
I don't know exactly when
We
that
can
will
use
be.
this breaker here,
With
possibly
hindsight,
move
are
up.
there any signs that you can look back on now, looking at the reports from January or February or March?
Just
that
need some more
suggested
time in here.
Something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate.
So if
to
we go
reserve
higher, look at the
judgment
targets
until-
up here.
until we had the full quarter's data. Until
We
saw
got
the
this new
March
week
data.
opening gap
So
we could draw to.
what do we now
Okay.
see in the first quarter? We
I don't
see
think that's out of the question
strong,
right here.
economic
So it's
activity.
about
We see
150
strong
points where we are
labor
right
market. We see
now.
inflation. We see three inflation
We just had a
readings.
strong 15-minute
So I
closure.
think you're at a point there where
Up
you,
above
where you
this
should take some
15-minute
signal.
Inversion for
we
value
don't
gap
need to
there.
react to 1 or 2 months data,
So
but
I'm
this is the
liking
full
that
quarter.
for
And
possible
I think
movement
it's
higher.
appropriate to take signal now, and we are taking signal. And the
So
signal
this
that we're
is,
taking
if we were to
is
get in
that
this
it's
now,
likely to take longer for us to
I mean, that's a
gain
pretty fat
confidence
risk, to be
that we
honest.
are on a sustainable path then to
But,
2% inflation.
honestly,
That's the
price
signal
like
that we're
doesn't
taking,
look
you know.
terrible. Like it really doesn't.
And Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them
Let's
to
see.
work out in the coming months and quarters?
Yeah.
Close
So
that there.
We will, you know, we will put the thing. We have put the thing under a microscope. I will say, nothing.
Had a little $300 move, little 360.
I think that in fact,
Leverage is
we
so
didn't
high
gain
right now.
confidence in that it's going to take longer to get that confidence. But confidence, I just think I mean, you know the story.
I'm gonna trade
what,
micros.
What's happened since December is
It's
you've
so high
seen,
right now.
higher
MNQ, there we go.
goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had.
Went away
There's
for more
stories
information in
behind
this area.
How that happened, and you know, I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was.
He just said it's lower to have inflation come down than
Those
what it
things
was
we also
before.
Continue to expect, and I continue to expect.
So he had higher
that
expectation of
services
inflation coming
given
down
the market
before than he
itself,
does right now. So that's like not a good
will show
sign.
up in
But they're also not saying anything
services
terrible. You got to
inflation
think
over
about
time.
that. So like that's good
We
for the
believe that
markets.
it will,
You know,
just it looks
he's
like
not saying
there
anything
are
terrible.
substantial lags between
And like the market
when,
kind of told us that
you know,
already
market
for market
rates
structure
come up and,
before.
for new tenants.
So notice how
And when it shows up for existing tenants
on the daily time frame,
for in-housing services.
we have a higher low,
If I
higher
could follow
low,
up, is
a
there
lower
bit of
low.
contradiction in the idea that you are
Go to the 2-day. You can even go to the
reducing
weekly.
quantitative
Look at the
tightening,
wicks
which is
here.
sort of
Lower
easing
low,
while
higher
you're
low.
holding
That's
rates steady
bullish
and
SMT.
restricted rate to try to slow liquidity.
So that bullish SMT is basically saying, okay, let's look for signs to move higher. And since we are already in this discount here, I was looking for price to really start rejecting this discount in this order block to move higher. So that's obviously what we just got, you know. And we're getting some big bullish movement out of here. 2-minute closure, very, very bullish. We have a draw on liquidity up higher.
To be less restrictive to the economy, it really is to
So,
ensure that the process of shrinking the balance sheet down
yeah,
to where we want it
yeah.
is a smooth one and doesn't wind up with
This is just a lot of risk for me to want to get in right now. I mean, 80 points. I mean, 20, 40, 60. Yeah, it's still fat, even with 5 micros.
Two questions. First, simple one. Given the run of data since March, has the
I want to see if the swing low gets hit once more.
this year increased or
I'm okay with missing out on this move if it doesn't want to come down once more.
Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria.
So
about
more bullish
inflation.
SMT in the wicks.
You know, nobody likes it. but
30-second inversion playing
is
out
there
pretty
an
well.
argument for being patient and working with the economic cycle to get it down over time. Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that you know, we've said that we didn't think it'd be appropriate to cut until we were more
I
confident.
just want to wait for more information, honestly.
Inflation was moving sustainably at 2%. We didn't get.
If it goes up without me, it goes without me then.
increase
You know,
in the first quarter.
that's what it is.
What really happened was we came to the view that it will take longer to get that confidence, and I think there are, you know, I think it's the economy has been very hard for forecasters broadly to predict.
Had a little bit less than 0.5% win on one move already.
To not cutting, and there are paths to cutting.
So we'll see what happens here.
In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually, it's the time to get back there, times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we refer to in the statement. As inflation has come down now to below 3%.
There goes, moving up.
On a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Use that breaker right there. I'm not interested in buying this right now. I'm okay with missing out on it. Dude, I'm so damn tired too.
Path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And
cool.
I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be enough sufficient. I don't know that it won't.
I still like that though.
Lead us on that. In terms of your question,
Still like that move down here. See that? Lower low, higher low in the wick.
I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have
looks like we're gonna get up to that gap up there. We're already tapping this gap here on ES.
growth, which is pretty.
We keep pushing.
I would say by any measure.
Yeah, this thing's gonna move, bro. Fucking A.
3%. So I don't really understand where that's coming from.
Using the 3-minute propulsion here.
In addition,
Using the order block, propulsion, whatever you want to call it.
including our forecasting.
Looks like we're gonna be using that.
That last year's
Push up.
growth was very high, 3.4% in I guess the fourth quarter, and probably not going to be sustained, and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%.
Nothing's really calling my name to get in this bitch right
I
now.
don't see the stag or the inflation actually.
Did you just say you don't see the stag or the inflation?
Michael McKee from Bloomberg.
Yeah, you're funny, bro.
The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply
I'll be right back.
policy isn't tight
the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restricted to bring inflation sustainably down to 2%, then that would be what it would take.
Oh, we used the order block, bullish SMT.
We don't see evidence for that. So that's where we are.
There we go.
Discussion about a rate hike at all?
That's what she did.
So the policy focus has really been on what to do about holding the current.
This is probably what we're getting right there.
Restriction. That's really what
1.5 to 1.
That's where the policy discussion was in the meeting.
I don't really trade based on that. It's not my trading plan.
Of persistent inflation that would trigger a rate hike.
There isn't any rule. We can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing.
Equal highs just hit. Got more equal highs up here.
It's going to depend on the totality of the data.
Massive dildo candles just ripping in. 300 points today. Holy fuck. It's wild.
Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is, and we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple 3 years ago. Essentially all wage.
Nobody rugged the market.
But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to be to have come down, and essentially it was flat year over year.
All right, let's see.
Roughly. So
Let's see if we get that inversion now,
it's-
or we pull back.
Part of it is bumpy.
Let's see if we get
And,
that pullback
again, we
consolidation
don't
for the next little bit,
but
and then
in the longer run,
if we get a continuation, you know.
if you have wage increases running higher than productivity would warrant, and,
Let's see.
then
Let's see.
will
see.
be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been
3 hour.
inconsistent, but we have seen a substantial decline.
3 hour inversion right
We
here.
have ways to go on that.
Okay. That's nice. 2 hour hasn't closed yet. Got another hour left. So that closed at the end of the day. 4 hour has 2 hours left.
You mentioned consumers, and consumers are feeling the weight of interest rates.
The election is
right now.
not part of their
Mortgage
thinking.
rates are
Yeah,
up, as
bullshit.
are rates for car loans, credit cards, people looking
They
to
can't
borrow
say
at
it's part of their
various
thinking.
years.
That's not a good
reflected in their
good
views
way.
on the
It's not good for
economy. What would you
business.
say to them?
Well, the thing that hurts everybody, and particularly people in the lower income
Overall, like,
brackets, is
we came to a
inflation.
discount,
If
we
you're a
traded
person
higher,
who's living paycheck
and
to
obviously
paycheck,
it looks like it's moving higher. Like, where's the next draw on liquidity? I would say it's still higher if we still get bullish closures.
go up in price, you
I want to see pullbacks
and so
down into these
those people in
inversions.
mind in particular, what we're doing is we're using our tools to bring down
More
inflation.
consolidation, more
It will take
liquidity
some
taken
time,
on the
but we will
lower time
succeed,
frame,
and we will bring inflation back
and
down to 2%.
moves up higher, you know.
That's what we're doing.
I think
We
it's
know that
possible.
it's
I think that
painful
NLOG
and
is possibly to be met,
the dividends will be
but I
paid
need
in the
more
long
information
run
in
will be
this
very
area,
large,
you know.
and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at
So mini, 20
5.8,
points.
now it's at anyway. Headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't.
I can risk, I can risk
Are
60
current
points on
interest
this
rates
next
really doing
move if
that
I
much
need to.
to fight inflation right now
With
for
micros,
those
5
consumers?
micros.
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and it's also in this case unusually working alongside and with the healing of the supply side. This that was different.
There's
this
no
time
bearish
was that
SMT, which
a
is
big
good.
Part of the source of the inflation.
So it makes me
and the
bullish
reason why
still.
we're having this conversation.
I want to see what
is
price
that
does
the
over the
supply
next, I
side
guess you
kind
could
of
say,
collapsed with shortages and
30 minutes or so.
that kind of thing.
See if we get more price action and then lift
and
up
this was
to
do
here
with
maybe.
the shutting down and reopening of the economy and other things that
There's no rush to
that
getting
really raised
anything,
demand.
so just wait
So
here.
many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation.
Maybe it goes without
We
me.
made a lot of progress. Let's remember. how
It does,
far
that's
we've
fine
come.
too.
And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially,
Good question. I like this inversion up here.
in the economy where there's
And we got SMT at these lows with this 1 minute inversion.
Housing is one of them. So when you have
But it's still making me iffy based on these relative equal lows. Still like,
goes to rent an apartment,
I like
it's
this,
called market rent. And
but
you
there's
see
something
market
about it
rents are
I
barely going up at all. The
don't
inflation
want
has
to take,
been
you know.
very low.
I know we took out this low here. So this one
Before that, they were
hypothetically
they
should
sort
stay
of led
intact.
the high.
If we're going to go long here, we have the order
So
blocks.
What happens is
With the draw on
those market
liquidity.
rents take
5 minute looks
years
good for an
actually
order
to
block
get all the
retest
way
right now
into
to go long.
rents for tenants who are
So-
rolling over their leases. Landlords don't tend to charge as much of an increase.
So what are
to
we
a
looking for?
rollover tenant.
17,
And what that does is it builds up
836.
a sort of an unrealized portion of increases.
That's
There
it.
have been big increases, and what happens is,
It's only like a
complicated, but
1-to-1
the
if we're
story,
going to
it just
there.
takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will we
But I do like that 5-minute order block, so I'm going to be paying attention to this as well.
We now think significantly longer than we thought at the beginning.
5-minute order block.
So confident that it will come, but not so confident in the timing of it.
We'll see if that holds up or not, or if we come back down once more. I do like that we traded down lower over here. So that gives me confidence on this. And same with that 9-minute as well.
This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory.
See this 15-minute as
Easing during
well.
the pandemic, fighting inflation, with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank
So if we start to get SMT up here at these highs, this could flip bearish.
So, you're right. I think that may happen.
But we don't have the
You know,
SMT yet at the
also
highs.
Domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. They have their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury.
So now I
of
just
having
inverted this
strong
1
growth,
minute
strong
here.
labor market, very low unemployment.
I'm thinking maybe like one more swing low and then a push.
We can be patient, and we will be careful and cautious as we approach the decision to cut rates. Whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the economy.
I wonder if we're going to get this. A pullback into here.
And I think,
Retest of
we
this.
haven't seen,
684.
For the emerging market economies, we haven't seen the kind of.
And then I
turmoil
move
that
up,
was
but
more
then we have
frequent 20 years
lower
ago,
low,
30
and
years
then maybe
ago.
we get a higher
And
low
that's,
here.
I think partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation, and so they're navigating this.
So all
pretty well
depends.
this time.
Came down into this wick. We took this
Thank
liquidity
you, Chair.
here.
Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was.
Let's go, baby.
That so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy.
4-hour gap here. Let's see if this is closed. Get another hour or 45 minutes.
As well. The unwinding of those really helped inflation.
We'll see if we close that. Dude, this might be a ripper, dude.
So I think it is possible.
No big SMT down here though, but we did hit the fair value gap and do a discount.
To help us bring inflation down.
So we'll see. We'll see. See if it rips.
Guarantee that that's true though, and so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but
I say we go to this end walk by the end of the day, baby.
And get our attention and lead us to think that the labor market was really significantly weakening.
Or not.
A couple of 10 points in the unemployment rate would be.
It's if we get the SMT somewhere.
Do that, but a broader it would be a broader.
And that doesn't hold, you know. So let's see.
Be appropriate to consider.
See if we push it.
Cutting. I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
We also have 25% of that gap too. So.
Chair Powell, thanks for taking the question.
25% of that gap, we're just gonna
you've said
maybe
that
reject it
broader
there.
material changes are needed for the Basel III
Consolidating.
proposal.
It's not really giving us that
You've
movement we'd
mentioned
like
that
to see.
A reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front?
There's SMT at the highs, higher high, lower high there.
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame.
Well, we'll see if it wants to hold or not.
And also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve any issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect
This buy, there's a lot of risk in this buy right now.
Other, agenda items?
To be honest.
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
So when did this close here?
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the table, frankly more diverse than it used to be in many dimensions, more diverse both from the obvious gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
It's closing down below that gap now. Let's see, 2, 1. Yep, close down below that gap. Let's see if it hits that swing low. If it hits that swing low, it might reverse. We're back down below the swing low. Let's see if this thing continues to sell off. Or if we actually get our entry, you know? Maybe we actually get like a fair value gap they've been talking about to go long. Alright, he's done speaking, so we're good. We're good here. Let's get it. Alright. So yeah, we're just pulling back now. We still don't have the bearish SMT at these highs. So this is kind of what I want to see. This pullback coming into the rest of the day here. Coming down into discount down in here. Yeah, areas did not want to hold up there. It's all good. The better area was this 30-second inversion right there. Retested it using this order block. These equal highs to go long, you know. Unless we go back for the data lows, that'd be sick. We get some massive sell-offs here, inversions, and then a retest. That'd be crazy. We've so game over. I just don't think that's gonna happen though. Because now we're inversing this here. Sort of block. Get the news lows all the way down here. Just need to see SMT though, that's the thing. I don't know, I just don't see it because lower low there, higher low here now. So, gun in my head, if we get an inversion down here, I want to go long still. But I need to see something clear. Like this 15-second inversion's nice, but I'm not a huge fan on 15 seconds. You know? I think it's possible. Alright, we're moving up. I took that, move it to break even now. Unless, wait a second here, 15 second. There we go. Yeah, I'll see if she wants to rip now. Damn, that's a quick 15-second inversion for value gap. Holy shit, we're fucking ripping her, bud. Jesus. Where was I looking up there for target? Let's see. Yeah, that's a 15-second entry right here. But no, I'm looking higher. I'm looking 835. 835. That's what it was. 835. 836. Yeah, let's see. That'd be nice to move if we get it. don't know. I saw the SMT and the 15-minute wicks. It made me want to look for buys, you know? Now, if we get this inversion here in the 2-minute, which I don't know if we're going to, which could be bearish. Let's see. Like I said, I like the NWOG with the draw today. Dropped the NWOG. Oh, look at that 2-minute inversion there on ES and on YM. Try to get a 3-minute inversion as well. Hey guys, I was looking at this buy right down within here. So when we started selling off, I was liking the buy opportunity down within this area. I'm looking for this NWOG up here to be met. And if we get that, that's the target I'm looking for. Okay, so what made me want to go bullish? I mean, we had fundamental news that was good, but I'm not a fundamental trader. So technically, we are bullish on every other time frame. Okay, even on the daily time frames, bullish SMT, all that fun stuff. But bullish closure, we retraced into this hour, retraced down into here, into this previous order block, so this breaker over here, and then I'm looking for higher targets up in this range, up in this fair value gap, for the NWOG to be the draw on liquidity for either ES or NQ. But I personally like trading NQ. So I had a tight entry over here on this trade. I took this inversion gap right here in the 1 minute. So we closed there. I took the trade, consolidated, maybe stop below here after 10 minutes, traded down to my stop. We traded lower, and as I was saying, I like it. I like how this is trading lower. So now I want to watch and see what happens. So I go down to the 30-second, didn't see any gaps. But I did notice we actually made a lower low here. Lower low on the 15-minute, but a higher low on NQ and ES. So bullish SMT. So going down to a 15-second, I saw this 15-second inversion gap, and that's where I took the entry, right here. So after that inversion took place, everything lining up, I decided to take the risk, and we go for a whatever you would call it. Let's see. It reached up 50 points, risking about 33. So that's pretty good in my opinion. We're going to see if it wants to continue up or not. I mean, it's coming back down to the rejection block. So we'll see. But ideally, I'd like to see the low of this 15 seconds stay intact. We are going to go long still. So I'll be paying attention to that. I know we have bearish SMT at these highs now. So if we actually do get a really bearish closure here on this 5-minute, we could be looking to go to data lows in a little bit. You know, I know we're also getting a 30-minute closure as well, so I want to pay attention to this 30-minute and see how this next 30-minute starts to print. Do we go down into the gap that it creates? And one doesn't, we go higher? Or what? Like, it all really depends. So I'm just going to be paying attention to what happens over the next little bit. So let's see here. We're already pulling back down into this range. We just hit that 15-minute low, well, 15-second low there. Let's see if we trade down below this 30-minute here. I'd like to see that tap into here and stay higher on one of these. And maybe get a rejection and go higher now. That's just what I'm paying attention to. See what we get. Honestly, that SMT looks like we might be going down to data lows or down into here. Well, let's just sit in my hands, you know, wait for more information. Just tap that low again. Overall, you gotta think about it. Data lows are down here. If we stay heavy over the next little bit here, maybe we get the sell off into the close. That'd be nuts. But now it's just, right now we're tapping. Damn, they all tap that 30-minute gap. I don't like that. I would have liked to see one of them stay higher. Yeah, this is gonna be hard to see, like a 1 hour candle really just doing that. You really gotta think about that. You don't see that much. It just trades so bullish and the next one just sells all the way off. No, it's usually a wick, if anything. Yeah, I'm still bullish on it. Like, I'm trying to find a time, like last time I did something like this. Like that, it's not gonna like sell right off. Let's see what we get here in this price action though. We're back into this discount in here. I'm allowed to do its thing, but I mean if we inverse a lot of these gaps now and we still have bearish order flow, we maintain heavy, you know, it goes, we obviously are not right on the bullish side. But I like that we're coming down and rejecting it now. Okay, back down all the way below that inversion that we have over here. Okay. Okay, lower low there. We have a 30-second for value gap right here. With bullish SMT in the wicks. So how much would this be? Fucking still 40 points, holy shit. It's crazy. Did we inverse that? No, we fucking didn't. We actually didn't even inverse that shit. That's crazy. Notice how I was just up here in the last second and just came down. That's how you know there's fucking algo in this shit. Right before I was about to close. 1 second before I pulled right back down below that gap. That's how you know there's an algo in this bitch. Guarantee everybody's just watching that. That 2-minute gap up there. Dude, this shit stays heavy, man. I mean, that's gonna be the sell-off here. This 2-minute inversion. I'm just not a fan. 15-second for value gap. Does that act as bearish order flow or not? It might. 9 minutes closed like fucking bearish as all hell. So honestly, this 15-second might send it down. I'm just not trying to pick both directions right now. Just wonder what they want to do at the close here. They did have everybody going long at the news. Let this reach up to. Jeez. Yeah, just looking at this now, it looks like we're going to data lows for sure. Data lows are down here. The 9 minute, the 2 minute, the 5 minute. They're all like closing heavy. Three minutes about to close pretty heavy down below this inversion here. See how this acts here. Does it close down below it or not? Yes, it does. It's heavy, you know? Like this shit's heavy. It's like it looks like we're going towards this low down here. You know? Data lows, baby. Just like this. Data lows, data lows, data lows, data lows, okay? These news lows. Let's see if they get fucking hit. That 3 minute inversion gave it to me. We're heavy, you know? Of course, it's gonna fucking reverse and go right back up here. Five minute heavy as fuck. Closing below the inversion there. Dude, unless we just discount reverse this bitch. There's no SMT at the lows though, that's the thing. That's the issue. That's probably got everybody in the shorts now. Right there. see. It still looks heavy, man. New day opening gap here for a draw. Data lows over here, data lows here. Another minute left. Let's see if this 15-minute inverts. Yeah, I feel like it really depends on this 15-minute too. I'm gonna watch this 15-minute. Another minute left. Yeah, honestly, it looks like it might. Watch this shit come back. Yeah, it's back into the gap. That's crazy. No SMT. Oh, we do have SMT in the wicks. Yo, that's nuts. $15-minute closed. Oh shit, it closed up above that fucking inversion. That's wild. And maybe we don't go to data lows, you know? Maybe this gives us a chubby wick, dude, to get some SMT down here. Maybe one more low, swing down. Yo, that's so fat. Second inversion right there. Retest. Order block. Move up higher, baby. Got these relative equal highs up here. Let's see if she gets up there. I don't know. That'd be fat, though. feel like they just got so many sellers in right now. Order block for value gap. I know we didn't hit the end log or end dog there. We'll see. Yo, that'd be nuts if we just... I doubt we're gonna reach all the way up there, but you know, I'd say minimum 50% of this range. And it's really not that far away from here. Just 650. Could lock it in at 650. Lower high, bearish SMT. Break even about to be hit. Alright, break even hit. I'm just staying out for right now. We're gonna get our market on close or macro here. Lower low, higher low. Still don't like this shit. Another bearish 3-minute closure. Let's see if that sends it down or not. Looks like it is, you know? Looks like we're going to data lows. Really does. Bearish order flow. It's acting pretty clear. Bearish SMT at these 30-second wicks now. You know, like even here. Stop there, targeting the low. Right there. I'm not doing that, but no, it looks like it. This is hard because we're now like in the end dog. We got this order block and a lot of movement we got to get through here, but it's looking like it wants that money. It's so cool to watch everybody manipulate this. That's gonna be newest lows here. That's wild. That's what they're going for. It's fucking obvious. You just hit him over here. Yeah, Lion's gonna hit even lower too. It really looks like it wants to. We'll see. We hit the low there. If it gets a really fat reaction off this, maybe we do inverse this 1 minute and go higher. I'll pay attention to that. But ideally, I'd like to see these lows hit first and then maybe a shift back in. It's gonna have to happen quick. It's already 53. We're already in the end dog. Bro, this shit is so heavy. Sheesh. Yeah, one of those news lows. Let's get it. Okay, hit news lows, now what? That's the question. Do we get an inverse anywhere? We push it? What do we do? So yeah, we basically had bearish SMT up here. With YM indicating the sell-off, you know? Yo, that's so crazy. Shit you just don't expect to happen just happens. Another 15-second inversion. Is there SMT that's a question. Only if there's SMT that's valid. No, there's no SMT here. Low taken, low taken. Do we go to this low? Do we not? Lower low, higher low. Just gotta get some reaction. I doubt we're gonna get much here. That's wild. Alright. Sweet. That's it for me today. Not really too much. Kind of hard to read, to be honest. But, yeah. We're good. We're good. Back at it tomorrow. Excited. It's a good day. Alright, see you guys later. Take it easy. Love y'all. Peace out.